All right, perfect. Make sure we are good. All right, posting the feed, and then we'll get started in a quick second. Good evening, good evening. Welcome to tonight's live. Today we are doing a 2024 U.S. Multifamily Investment Outlook, just to give y'all some updates on the market, a little market perspective. And that'll be it. We'll be out of here in 30 minutes or less. All right. All right. All right. Let me just double check, make sure I'm good across the board. Mm, All right. Beautiful. Okay. So it's actually been, all right. Let me cancel out of here. Leave. Yes, I want to leave. All right. Cool. Cancel out of that. Leave. Yep. All right, perfect. All right, so welcome, welcome, welcome. It is what's today? Today is Wednesday, February 21st. Time is 7:02 p.m. And I am your host tonight, Kevin Sharif Breckenridge, and we are happy to be in the building. It's actually been a while since we've gone live from our Facebook page. So tonight we're going to go live and we're going to talk a little bit about multifamily real estate investing. And specifically, we are going to do an investment outlook for the year. This is actually, man, this might be year three already, three or four. I forgot to check before I hopped on, but anyway, this would be year 3 or 4 that we've done the investment outlook, and so I just wanted to continue to keep that momentum going. It's always good to check in at the top of the year to give some insight on what's happening in the market, and if you aren't on our newsletter, and I'll drop that in the comments. If you are not on our email list for our newsletter, I'm gonna go ahead and drop that in the comments. And this will give you a chance to really stay up to date throughout the year and not just on an annual basis. We actually send out a lot of good information every single week on, of course, what's going on in the market, but also just keeping you abreast of the different things that we have going on our online platform. So if you aren't on that newsletter, go ahead and hop on. All it takes is a first name, last name, and an email address, and you'll start getting our weekly updates as well as other email communications. But it's a great way for you to stay up to speed. And one of the things that is very, very, very important, and sometimes with myself is overly important, is the training and the education piece. And before you're ready to take action, before you're ready to move, or even if you're trying to get to the next level in whatever area of your life, you're talking. Oftentimes, there's got to be a increase in education. There's got to be an increase in training. So by becoming a subscriber to our e-newsletter, you'll definitely be able to up your knowledge and your information game. I've been sending out, let's see, we've been sending out that newsletter. We're actually in year 5. And I can tell you that in the 5 years that we've been sending that out every week, I think we have missed less than 5 additions, right? We try to execute that every week, but I think in that 4 years, we've only missed about 5 weeks. So I say that to say that we are definitely on the pulse of what's happening in the multifamily space. So if you want to make sure that you are ahead of the competition, and most importantly, making sure that you're making good decisions, definitely check out that e-newsletter. So today, we're going to focus more on just covering what's happening on a national basis. And then if you are watching and as we get towards the end, if you want specific market coverage, just go ahead and drop a note in the comments, and we'll be able to give you some specific market coverage across certain markets across the country. But today we're well, at least on the first half, and unless we, get to the end and we have some specific requests, we're just going to cover everything on a national basis. But the national story is actually quite consistent with what's happening on a local basis. So you could take the information and utilize the context of that to do further research as needed across specific markets. So the way I wanted to do this is I used to put together, I used to do the slideshow and the screenshots and all that type of stuff. But I figured today I really didn't need to do that. What I'm going to do is I went through, I have a set of companies that publish great market information on a regular and routine basis. So I have a list of research institutes basically that I like to review their market reports as they publish them, whether you're looking on a quarterly basis or an annual basis. And so I went through all of those reports, and out of all of them, one of them really is pretty solid, and it's all of the reports are consistent. So I figure what I'd do is I'd cover that one report and just tell you that consistently across the board, the other reports are solid. But what I'll do is I'll tell you really quickly what list of reports I am using. So if you do want to do some additional research, you can do that on your own. So if we're going to use multifamily market reports from CBRE, which is CB Richard Ellis. Our main report that we're going to pull from today is our Marcus and Millichap report. And then we're going to use our Yardi Matrix report. We're going to, we also looked at the Yardi Matrix report. We looked at the Viewpoint IRR report, and we looked at the Cushman and Wakefield report, all covering 2024 and giving a projection. And I think the only one that was mostly geared towards Q4 of 2023 was the Cushman and Wakefield report, but with the context of leading into 2024 and what the projections and everything looks like. So what I'll do is I'll do a quick screen share. All right, Marcus and Miller chat. All right, we'll hide our floating meeting controls. And hopefully, let me just double check, make sure that y'all can see the screen I'm looking at. All right. All right, perfect. So y'all can see that screen. All right, so here's the Marcus and Miller chat report. I'm gonna zoom in a little bit. We'll center that so you can see it a little bit easier. And we'll just kind of go through the report. All right, so this is 2024 multifamily, the national investment forecast, and we'll start off with this is the basically the letter from the research department, senior vice president, and senior vice president, another senior vice president of multi-housing, the multi-housing division and the research services. So really quickly, the economy has proven to be much more resilient than expected, and the broadly anticipated recession never came. I'll come back to that. Instead, employers added jobs at a steady clip, keeping the unemployment historically low, under 4%, supporting strong consumer spending, even in the face of lingering high inflation. Now entering the new year, the momentum appears to support sturdy, albeit modest, economic gains in 2024. So if you've been watching the economic news, you know that they've been predicting recession for a while. And there's the question of, hey, is a recession coming? Are we in a recession? How big is the recession going to be? Well, just interestingly enough, although we haven't hit a recession per se in the U.S., I have seen within the last couple of days, even today, that you have some formal recession announcements from Japan. You've got recession announcements coming out of Germany, and you've got recession announcements coming out of the UK. So I'm interested to see how the year continues on, if that those recessions that are popping up in other countries will have any impact. Of course they will to some degree, but to see what impact they have on our own economy. And then also, although we aren't in a recession, definitely inflation is still a monster, and is still causing price increases. And one of the interesting things about the US economy especially is it's a spend-based economy. And so a lot of people were able to accumulate savings during the pandemic, and that savings has been dwindling. They still have it, but it's been dwindling over the last couple of years. And so we're getting to the point statistically where the savings rate for Americans is not at the high that it was during and immediately preceding the pandemic, or I should say 2020, 2021, even 2022. So as that savings rate continues to decrease, what you're seeing now too, also you have a higher rate of credit usage. So that's showing that people are utilizing credit to cover their cash crunch even more. So although we may not be in a recession now, we also are seeing a lot of signs of layoffs, mass layoffs, especially in the tech industry. You've got people laying off by the tens of thousands. So we aren't necessarily in the clear. Plus, we know that interest rates are still high, and there's a lot of speculation around whether or not those interest rates will come down this year. I think that if there is any type of reduction in the interest rates, it's going to be modest, very modest this year. So we can still expect to have high interest rates, but we'll touch on that in a few. Continuing on with the letter, against the complex economic background, the nation's multifamily sector is contending with its own challenges. This has definitely been, some big challenges, but we'll cover that. The chief among them being record new supply. By the end of 2024, nearly 900,000 apartments will have opened since the start of 2023. So basically, by the end of this year, over the course of the last 2 years, you would have an average about 450,000 new apartment units. While many of these completions are slated for faster growing secondary and tertiary markets, which captured household relocations from the pandemic, operations will still be pressured in the near term. At the same time, the affordability landscape between markets is also shifting, which has implications for performance this year and further into the horizon. And ultimately, every market is following its own trajectory. To help commercial real estate investors capitalize on the complexities of the investment climate, Marcus and Millichap presents the 2024 National Multifamily Investment Forecast. All right, perfect. Thank you, and here's to your continued success. So we're going to dive down a little bit more, and some of the things actually I want to touch on: the 450,000 a year average of new units coming online. One thing about that is, as you have this dramatic increase in supply from a national standpoint, we have a significant shortage of housing that's projected over the next 10 years. So in response to that significant shortage, and in response to the low interest rate environment, the migration during the pandemic, you have had a lot of new development. And that new development, one of the things they had mentioned is that new development is not really even across the country. It's in hot spots, right? Hotbeds. And so although there's a lot of supply coming on, one, statistically, we need 450, 500,000 a year of new units just to keep up with the projected shortfall that we already have. So this could go on for the next 10 years and still be just on par with what we need at a minimum. And then with that much supply coming online, what that does in the short term is it causes a depression or a slowdown, I should say, in the rate of rental growth. So one of the metrics, or one of the drivers of value in multifamily, is how much you can raise the rent over time. So right now, prices are kind of stagnant, depending on the market. But as more supply comes on and there's more vacancy, you have higher vacancy rates, and then you just have a slowdown in that short-term rental growth. So those are the implications there. All right, so let's move on down a little bit. All right, let's see. All right, executive summary. I'll touch on a couple things here. One, the positive momentum from The economy, we've got a positive momentum will carry forward in 2024 as household net worth has increased by faster than average 33% since the pre-pandemic peak, well eclipsing inflation. That's what we talked about. One, also people earning more and being able to earning more or earning the same, but being able to relocate to cheaper or lower cost environments and still maintain their job through remote work has allowed people to save more. Let's see, higher borrowing costs. We talked about the increase in the interest rate. Higher borrowing costs together with rising operating expenses could prompt employers to do more with less. Job growth is set to be around 2/3 the 2023 pace this year, or possibly lower if economic conditions temper more than expected. While a soft landing to the Federal Reserve's tightening policies is still more likely than not, a misstep would not be hard to take. So what you have there is you have a lot of employers, still a lot of people hiring, of course, but one thing, and I mentioned with the tech layoffs, companies are navigating and trying to figure out what's going to happen. And in preparation of what's going to happen with the economy, one of the things that they're, a lot of companies are doing is they're slowing down hiring, they're freezing down hiring, or they're laying people off. All right, so let's see. We talked about on a national scale. Let's see, developers are outpacing last year's record of 420,000 new units, and this year they're expected to come online with 480,000 new units for that total of 900,000 over the course of 2 years. Let's see. Capital markets. This one is just talking about the Fed and the Fed being on an aggressive 18-month hiking spree, which since last July, I think they've been holding on. We've had one. What was the last rate increase? I think it was in December. We've had one rate increase or one recently. Right now, we're holding steady, and everybody's just waiting to see if the Fed is going to start to lower rates this year. And if they do, I don't think that they're going to lower rates as quickly as they raised them. Definitely, they're going to take it a little bit slower. So although people are like projecting, and it's just wishful thinking, hey, the Fed is going to lower rates this year and it's going to spur all of this investment sales activity. I personally just don't think that that's the case. I think it's going to be a slow and steady and methodical decrease, especially, again, considering prices across the board outside of real estate and multifamily haven't really budged. As well as multifamily prices still, you still have a pricing gap there. All right, so let's see. While capital is available for multifamily investment sales, underwriting criteria has tightened and borrowing costs are high. Banks have prioritized debt held by existing customers, and many have chosen not to consider new loans as they restrain balance sheet outflows. As a result, investors have once again become highly dependent on lending from the government-sponsored agencies, and borrowers familiar with this interest rate environment which is similar before the 2008 market, may be more active this year. They've got a little more familiarity navigating the market. And as far as the GSEs, the government-sponsored GSAs or GSEs, government-sponsored agencies or entities, they already provide a substantial amount of liquidity to the market, somewhere north of 50%. And that number will continue to increase definitely during these challenging times, as the federal government knows that, hey, the nation needs housing. So they've got to fill that funding gap as private institutions pull back. And then actually on today's e-newsletter, there's some information in that newsletter talking about a list of 59 of the country's smallest banks or small banks and how they're faring and what their threats are in terms of their own balance sheets and in relation to the loans that they have outstanding with multifamily. You've got a lot of people defaulting on their loans, their multifamily loans, because of the cost or the price pressures and squeezing of the investment returns. So definitely a challenging market in a lot of respects, but people are still finding opportunity, albeit extremely harder to find. All right, let's see. So the investment outlook, the multifamily investment sales climate has realigned with historical norms following 2 years of record trading. As a sharp rise of interest rates widen the price expectation gap between buyers and sellers, yet slower rent growth, elevated vacancy rates, and higher operating costs have also weighed on seller motivation. In addition, the much anticipated deluge of properties driven to market by maturing debt, higher refinance rates, and tighter debt service restrictions has not materialized. As investors calibrate to the more stable but higher interest rate climate in the coming year, sales velocity should steadily gain momentum. So, excuse me, on that paragraph, one interesting thing that we're seeing a lot of is there's a lot of people who are lining up funds and raising capital for what they expect to be a wave of distressed assets. And although there are distressed assets happening in the market and distressed sales happening in the market, we just aren't seeing it at the level that people were projecting or were expecting, at least not yet. So some data says that, hey, the default rate and the pre-foreclosure rate is basically not really that high. But then there's also a lot of things in the mix that could be masking or hiding that potential threat. So it's definitely something to keep an eye on. Moving on, here's one thing that I'll cover. This is just information about single family homes and the challenges that the single family home, the residential market is facing with the increase in interest rates. And so that's basically a two-front problem. One, you have people not moving because with interest rates being high, right, that's affecting the overall market, affecting not only sales prices, but also resale prices, right? So if I have a house and I want to sell it and move into another one, the interest rate is so high on the house that I want to buy, it doesn't make sense for me to sell the house that I have. And so inventory is tight. And then also just with the increase in interest rates for buyers, it's making the cost of buying higher. So you have a two-front threat there, and that threat is ultimately resulting in just a slowdown in the housing market and making it more difficult for first-time home buyers to get into properties. And so what that is doing is causing a lot of people to live at home longer. And on the flip side of that, it's causing a lot of people to have to rent for longer. So it's increasing the renter pool, which is good for multifamily, but just wanted to give you some insight on what's happening across the country from a single family standpoint. And then this is just a graph showing sales, and we'll give a couple percentages. Let's see, out west, sales have slowed down 49%. In the Midwest, sales have slowed down 39%. In the Northeast, down 44%. And this is from the peak numbers of last year. And in the South, sales are down 36%. So you essentially can say that sales prices at a minimum are down 50%. It's pretty dramatic. And that, that's has a major impact on people's ability to move around and to get out of the apartments that they're in, or even their parents' home. So let's see, we'll scan down. I don't want to cover everything. Let's see, we actually covered a lot already. Let me see a couple things. Hiring, new year brings new growth opportunities. Hiring continues at measured pace. Costlier debt is a factor. Let's see. Employers' relationship with labor is evolving. Last year's better than average hiring bellied numerous underlying labor disputes, with groups spanning a wide swath of industries engaging in strikes. While the outcomes of these agreements generally benefited workers' financial health, additional business expenses could impact corporate investment this year. New labor disputes in other fields could also arise. Of course, when we're talking multifamily investing, one of the big things is employment and employment growth and what's happening in the job market. Home price appreciation bolsters household wealth, which is good for existing homeowners. The median sale price on a single family home nationally has increased over 40% since the end of 2019. So again, people are sitting on more money, and that's good for existing homeowners, not so good for the people who are trying to buy, right? Let's see, government spending may not be as supportive in 2024. One pillar behind the economy's strong performance in 2023 was the combination of private and public infrastructure and manufacturing spending. prompted by legislation signed in 2021 and 2022. Whether private investment will continue in 2024 amid the higher cost debt climate is unclear. The U.S. non-defense budget is also currently capped for 2024. All right, sizable delivery pipeline disguises the impact of improving demand as 2024 may prove key year for housing. We talked about record supply and the record pace. Right now is outpacing the demand again, so that's suppressing the market a bit from a vacancy standpoint and a rent growth standpoint. Let's see, tight housing market underscores need for rentals. We talked about that. The cost to buy a condo or a single family home today has skyrocketed due to both elevated mortgage rates and stubbornly high sales prices. Let's see, primary central business districts. This is a big one for cities, especially along the East Coast. Primary central business districts return to familiar performance levels. If you remember during the pandemic, everyone basically started to flee to city centers, especially your places like Washington, D.C. and Baltimore City and Philadelphia and New York. And people just started to flood all over the country trying to get out of the city because that high concentration of people was not good for COVID. So that depressed things for a while in the cities. But levels are returning to pre-pandemic levels, and those central business districts are balancing out. So that's good for the urban cores and the urban cities that depend heavily on those that renter, living in the central business districts. Let's see, regulatory environment continuing to evolve. This is another big one. Backed up eviction filings are still working their way through some court systems, inflating occupancies, but still stalling rent growth in certain metros. Rent control debates are also ongoing in several parts of the country. At the same time, efforts are underway to streamline development in high barrier markets. These and other initiatives have the potential to alter local multifamily outlooks. That streamlining development in high barrier markets is a big one to try to alleviate the housing crisis. One thing that locales are trying to do is they're trying to ease those requirements, those zoning requirements, those permitting requirements to make it easier for new development to go up. So that's a big one to watch. Let's see, class-based fundamentals could widen. Class B assets could have a challenging year if the cumulative impact of inflation pushes some renters to a lower quality tier. At the same time, renters by choice, basically people who could choose to live in a house that they own or rent. Renters by choice have numerous recent Class A bills to choose from, which could impact existing higher end properties, increase competition on the market. Let's see, Fed widely expected to ease rates in 2024. We talked about that. Not sure how much they're going to ease rates, but there could be some easing of the rates this year. Bank lending is tight and expected to ease. That's going to depend on the interest rates and how the loans continue to perform as the year goes on. It's extremely early in the year, so it's still to be determined how that's gonna go. Capital markets outlook, FDIC guidance supports extensions. This is a big one. In June last year, the Federal Deposit Insurance Corporation provided guidance to banks, empowering them to offer loan accommodations and workouts to mitigate commercial real estate debt stress. And though not every bank utilized this flexibility with all loans, it did alleviate some of the expected distress many anticipated from a wave of maturing debt. So again, we had talked earlier about the potential masking of the crisis. One of the masking tools of the crisis is what kind of workouts were borrowers able to work out with their lenders and basically delaying and deferring. Let's see, bank outlook improving despite the shutdown of several significant banks last spring. Most banks were reporting substantially strengthened balance sheets by late 2023. Again, that tightening of the belt. Commercial real estate distress and charge-offs have remained well below prior cycles, with less than 2% of multifamily trades last year falling in the distress category. Let's see, lenders restrain construction pipeline. Capital providers have become particularly cautious with construction financing. pushing rates above 8% as of late 2023. The higher cost of capital has helped rein in multifamily groundbreakings, offering an anticipated reprieve from the wave of development that has helped push vacancy rates higher over the last 2 years. And although apartment additions are expected to reach a new peak in 2024, this should represent the high tide mark of this cycle. All right, let's see. Investor strategies revive traditional perspectives, stabilizing interest rates aid market cap calibration. Interest rate consistency to bolster transaction activity. The multifamily investment sales climate has realigned with historical norms following 2 years of record trading. Transaction flow last year roughly matched 2024 levels, marking a significant decline compared to the cycle peak set in 2021, 2022. So things are just going through a natural process of resettling, right? They say every 10 or so years, the economy has to have a reset. I believe this current bull market that we have been on had gone for a little bit longer than 10 years. I think it was 12, 13, almost 14 years. So definitely due for a change. Then specifically from a multifamily standpoint, looks like we're right at that 10-year mark. Let's see, investors rekindle strategies common before the financial crisis. The prospect of flat or even modestly declining interest rates should bolster investor activity in the coming year. Significant capital awaiting deployment at both the institutional and private levels should begin to emerge, facilitating price discovery and helping to narrow the expectation gap. Again, that's wishful thinking. All data right now shows to that may or may not be the case. I'm leaning more so to that's not going to be the case. It's going to be a little bit slower, but not a bad thing to keep the hopes up. Just got to stay consistent and watch the numbers. Let's see. Investors continue to broaden their acquisition range. Roughly 40% of trades in 2023 took place in tertiary metros, a share that is now nearly in line with the 45% allocation to primary markets. Smaller cities generally face reduced supply pressure while benefiting from cost of living motivated in migration. Investors' pursuit of yield will likely reintroduce this trend in 2024. And then rising operating costs are a concern. Average insurance costs, we've covered that a lot over the last year or two. Average insurance costs have climbed by 120% over the past 4 years, driven by an increase in the frequency and magnitude of natural disasters, together with higher property values and repair costs. And when combined with a 40% average rise in property taxes since 2018 and higher labor costs, investor margins have been squeezed. And then the investor generation gap increasingly salient. Investors who came of age since the GFC have framed their strategies within the context of a 2.5% mean 10-year treasury rate and the rent growth ranging above 5%. Comparatively, investors active in the 90s and early 2000s operated with an average 5.5% 10-year treasury and rent gains near 3.5%, which align closer to the anticipated investment climate going forward. This could strongly influence which investors will be most active this year. So basically, experience will be the guiding teacher in this current market. So just a visual showing what the supply pressures are across the country from a development standpoint and the amount of units coming online and what that share looks like as a total percentage of the inventory in that location. So I'll stop here, give you a second to look at that, screenshot it if you want. And we're pretty much wrapping up. That outlook, just more just visuals of what we've communicated. So I'll scan through that a little bit. And then that's it. We'll start diving into our market specifics, but it's 7:34. So I'll scroll back up, leave this here. Check the comments real quick. I think we're good on market specifics. But if you do want a market specific breakdown, this is the Marcus and Millichap Multifamily Market Outlook report for 2024. You can log on to their website, create an account, and download the report. And it's got 69 pages of market insight and market data for markets all across the country. So anyway, that is it for today. I appreciate you all for logging on tonight. It's time for me to wrap it up. And I hope you enjoyed this. I hope this was insightful. Definitely is always helpful for us. So again, appreciate you logging on. And until next time, we'll see you soon. All right. Take care. Peace.